Being our last show day of the week, we take a closer look at parts of the global economy with an analyst that resides outside of South Africa. And so with the US Fed Reserve having just cut interest rates for the first time in over a decade and Brexit woes, among other issues, being quite topical, it's our global market review focus with Lukman Otunuga, who's a research analyst at FXTM. Thanks very much, Lukman, for joining us. So why, after the Federal Reserve cut rates by 25 basis points, did the dollar firm to a 2-year high against the likes of the euro? And why did equities take a hit, especially given the fact that the market had baked in a cut?
Yeah, one would have expected stock markets to rise to the stars and the dollar to collapse like a house of cards. But we're seeing the complete opposite. And it's one word, confusion. There's confusion over the Federal Reserve's forward guidance. And this has left me and many investors scratching their heads. So while the Fed expressed concerns over the global economy, trade tensions and inflation, they also were optimistic over the US growth and labor market. So it was mixed signals. And I think the biggest takeaway from the Fed decision was not the fact that they cut rates for the first time in over 10 years, but the fact that Powell practically said this is not the beginning of a long series of cuts. So even though the Fed has left the doors open for a rate cut,
yes,
I think many investors are thinking this is just a one and done. So we don't know. It's uncertain whether the Fed will cut interest rates again in 2019.
How much of this confusion that you suggest that the Fed governor has actually brought to the market, how much of it is him trying to also exercise his independence? Because there's a lot of pressure coming from a certain quarter, namely that of President Donald Trump. Do this, do that. So on the one hand, yes, they're going to cut rates, but they don't want to cut them too much and too fast because they want to be seen as independent and looking at data.
I agree with you. Jerome Powell is in a very, very tricky position, and this was part of the reasons that caused the confusion, because they didn't want to come across as we are cutting rates because Donald Trump is telling us to cut rates. They wanted to send a message that we are cutting rates, but further rate cuts will be dependent on economic fundamentals and global development.
Given the fact that markets didn't do what we would have expected, what then was the impact on the gold price?
Impact on gold?
Yes.
So we saw gold collapse. Okay, collapse is a very strong word. Gold tumbled. So gold has actually depreciated roughly 1.3% since the Fed decision. It went all the way to the 1,400 psychological level. Now, this makes sense because one of the main reasons that gold has traded where it's trading at such elevated levels is the fact that the Federal Reserve and other major central banks across the world are starting an easing cycle. But when we take the fact that the Fed may not cut rates out of the equation, this does expose gold to downside shocks in the near term. However, in the medium to longer term, gold bulls have nothing to worry about because we still have concerns of a slowing global growth, we still have trade tensions, and even if the Fed may take a pause on cutting rates, other central banks across the world are adopting our easing policy, and gold tends to perform well in a low interest rate environment.
The Bank of England kept interest rates unchanged today, and they've warned to those who care to listen that there's a 1 in 3 chance that the UK could go into recession. Is this all a factor of an almost inevitable hard Brexit?
I struggled to stay awake during the Bank of England press conference. It was a snoozer. I call it the Super Thursday snoozer because that's exactly what happened, and we saw it in the pound's action. So I think the thickening fog of uncertainty around Brexit has prevented the Bank of England from joining the global easing train this month. It's just 100 days until the UK potentially crashes out of the European Union, and the central bank has actually decided to leave rates at 0.75%. And what is really striking is that when we look deeper into what's happened, the bank actually has made growth predictions excluding the possibility of a no deal. So this is quite alarming because it suggests that there could be a disconnect with the central bank and markets over the UK actually crashing out of the European Union with no deal in place.
And as you look closely to what the likes of Boris Johnson are saying, do you think that is inevitable? Are you headed, or is the UK headed for basically a crashing out of the EU?
Inevitable is a very strong word, but it's becoming a live possibility because Boris Johnson has stuck to his guns. He said what he's going to say. The UK is going to leave the European Union, no ifs, no buts. If you look at his cabinet, they're all hard Brexiteers. And even when we look at reports in recent days, the rhetoric coming out from Boris Johnson and his cabinet, it's very, very pro-Brexit. So as things are heading right now, and the fact that we have a summer recess in Parliament, the clock is ticking. And the possibility of a no-deal Brexit is going to be a reality. But what I feel could happen is probably a week before the deadline, when reality starts to sink in, Boris Johnson may go to Brussels to request for an extension of the October 31 deadline, and this could open the doors to a general election or a second referendum. But at the same time, it depends what the EU wants. It's been over 3 years since we've had Brexit, and the European Union may be tired and be losing patience over this drama.
So the US-Chinese trade meeting in Shanghai came to naught, and officials are set to resume talks again in the United States in September. How much faith do you have in a happy ending on this issue, especially as Mr. Trump always takes to Twitter shouting at his opponents, like China, at any given moment?
Yeah, when we talk about trade talks, it just reminds me of an annoying itch that you just can't ignore. It's there, it's hard to reach, and you just can't overlook it. And this is what US-China trade talks are becoming. We're hearing about how talks were frank and constructive in Shanghai. What does that even mean? It's becoming a case where both sides are dragging things on, and markets may start to overlook the progress of trade talks, and this is very dangerous, because if we do have a situation where talks completely fall apart, or there's a miraculously talks are successful, the effects it's going to have on markets is going to be amplified. So this is what's happening right now. Yeah, we have talks set to resume in September, but I think markets have bigger fish to fry.
Let's turn to South Africa now, Lukman. We had those shocking unemployment stats earlier in the week for the second quarter, with official joblessness now standing at around 29%. And then late last week, Fitch added its voice to Moody's ratings agency about its concerns on government spending more and supporting SOEs like Eskom, taking the country deeper into debt. On the positive side, we had June trade data register a surplus, but of course that data is very volatile and very changeable month to month. So with all of that, what's the view on South Africa, and what do you think is the main reason for the Rand's recent weakening?
Yeah, the Rand has struggled to nurse wounds inflicted by Fitch's outlook downgrade last week. And when I was looking at the Rand, it's actually, since Monday, it's weakened against every single G10 currency. And it's one of the worst performing emerging market currencies this week. The string of disappointing economic data, the unemployment figures, especially the trade that showed that exports and imports fell, is quite negative, given how 30% of GDP comes from exports, account for 30% of GDP. However, though, there's still some light at the end of the tunnel. Now, there's a joke I say about the recent news with Eskom. So the government's decision to give Eskom that additional 59 billion rand bailout is like them playing a dangerous game of minesweepers with the ratings agency. And they were lucky last Friday that it just resulted in that outlook downgrade. I still feel there's still some light at the end of the tunnel. We've got 3 months left until Moody's rating. In 3 months, South Africa has the potential to ensure economic domestic conditions stabilize, going back to external risks. If the dollar continues to weaken, that will be good for the South African economy. If the South African Central Bank is able to cut interest rates again in September, this will support consumption, and consumption is a major part of GDP. And most importantly, going back to what we said earlier about trade talks, if trade talks are starting to brighten, this positivity will reflect back to South Africa. So although we do have a string of disappointing economic data and that downgrade to the outlook, I'm still optimistic over South Africa's economy.
That was Lukman Otunuga. He's a research analyst at FXTM.